I'm Andrew Murphy, Co-Chief Investment Officer at Winthrop Wealth. Welcome to our third quarter 2022 market review and outlook. Unfortunately, markets had another difficult quarter. The S&P 500 is having its worst start to a calendar year since 2002. And the US Aggregate bond market is still on pace for, by far, its worst year on record going back to inception of the index in 1976. Today I'll discuss several key issues driving the markets, including inflation and the Fed tightening monetary policy. I'll review performance in the equity and fixed income markets, and then I'll go over our outlook and portfolio positioning moving forward. At Winthrop Wealth, our total net worth approach, which combines comprehensive financial planning and investment management, is designed to help our clients navigate through these challenging periods. Now let's get to the video. We'll start with the key issue driving markets, inflation. Although several readings have decelerated from peak levels in recent months, inflation is still far too high. We have seen moderation in energy, commodities, used vehicle prices, expectation surveys, and break-even rates. However, stickier categories, including wages, shelter, and food away from home, remain elevated. Moving forward, the key will be for how long it takes for disinflation to increase and the growth rates to move back toward more normal levels. The Fed would very much appreciate a strong period of disinflation, allowing them to slow down the pace of tightening. Unfortunately, there just hasn't been enough evidence yet, and the wait continues. The Fed is working to bring inflation back toward 2% by tightening monetary policy through raising interest rates and shrinking the size of their balance sheet. After raising interest rates by 75 basis points at 3 consecutive meetings, the top end of the federal funds rate now stands at 3.25%. Thus far in 2022, the FOMC has raised interest rates by 3% total, the largest calendar year increase since 1980. The FOMC's most recent summary of economic projections showed that the median participant expected the federal funds rate to peak at 4.6% in 2023. The Fed typically focuses on balancing maximum employment and stable prices. However, today, the committee is hyper-focused on bringing inflation down, even if it means causing a recession. Fed Chair Powell recently admitted that higher interest rates will bring some pain to households and businesses. The S&P 500 decreased by 4.9% in the third quarter. Year-to-date, the index is now down by 23.9%. Through 9 months, the market is having its worst start to a calendar year since 2002 and is still in bear market territory, which is a decline of 20%. Stock market did stage an impressive rally from June to August, but it was snuffed out by higher than expected inflation data and the Fed's newfound resolve to raise interest rates to levels previously thought unlikely. The S&P 500 finished the quarter with a whimper as the index closed at a new year-to-date low of 3586, a level it first reached in November of 2020. Primary factors driving the market weakness still remain, including inflation, the Fed tightening monetary policy, higher interest rates, the Russia-Ukrainian war, and China's zero-COVID policy. More recently, we can add the potential European energy crisis and the United Kingdom's economic mess to the market's wall of worry. The bond market has faced unprecedented declines this year. The Bloomberg Barclays US Aggregate Investment Grade Bond Index, or the AGG, fell by 4.8% in the quarter, bringing the year-to-date decline to 14.6%. The AGG is on pace for, by far, its worst ever calendar year since inception of the index in 1976. Prior to this year, the worst calendar year performance was minus 2.9% in 1994. Bond prices move inversely to interest rates, and the negative performance this year was mostly caused by the increase in rates. The 10-year Treasury yield has increased by 232 basis points to 3.83% in 2022, as expectations of inflation have continued to move higher. Our objective with fixed income is to provide ballast, stability, and income to portfolios. And ballast means that, ideally, the fixed income holdings are increasing when equity markets are declining. Bonds have not provided ballast this year as interest rates have increased. Going forward, the investment-grade bond market likely just needs yields to stabilize to achieve positive returns. And in our view, a break in inflation would likely signal that interest rates have hit their peak. And on a brighter note, the bond market's yield to maturity, or the estimated annualized rate of return an investor can expect from a bond if purchased today and assuming there are no defaults, has increased to 4.8%, which is the highest level since 2008. In other words, future returns from the Ag Bond Index have not been this attractive in 14 years. Our long-term outlook on the US equity market is more optimistic now than it was at the beginning of the year, given the decline. Historically, the S&P 500 has produced an annualized return of about 9.4% per year. So we do expect some reversion to the mean after periods of very strong or negative performance. In the short term, our view is that for the market to reach a sustainable bottom, Fed tightening expectations need to soften, ideally through signs of disinflation. Over the long term, we suspect this difficult economic environment has created a strong buying opportunity for investors willing to live with some near-term discomfort. From a positioning standpoint, we entered the year prepared for volatility as we shifted portfolios more defensively throughout 2021 as the market moved higher in pretty much a straight line. On the equity side, we are overweight quality, large-cap stocks in the United States. On the fixed income side, we continue to focus on achieving ballast, stability, and income while keeping the interest rate sensitivity lower than the broader benchmarks. That positioning has served us well in 2022, and we still feel it's the best place to be going forward. We have made some tweaks by shifting toward value securities, but the main theme of this year is to maintain a long-term viewpoint and a disciplined approach, and continue to look for opportunities to tax loss harvest, rebalance, and selectively put money to work for clients that have recently made contributions to their accounts. We're telling clients to think in terms of years rather than days or months. At some point, the market will bottom and stocks will move higher. And we believe those who are able to either stay invested, rebalance, or add to their existing holdings will eventually be rewarded. Thank you for watching. Please visit our website at winthropwealth.com or click the links below to view our two most helpful commentaries designed for difficult markets. One is Market Timing Does Not Work, which details that the stock market has historically increased over time despite frequent drawdowns, the average investor underperforms due to market timing mistakes, and the benefit of a diversified portfolio and a long time horizon. And two is our framework for navigating current conditions, where we outline the benefits of keeping the right mindset, a comprehensive financial plan, and a disciplined investment process. As always, please let us know if you have any questions, and we look forward to speaking with you soon.